Hi, I'm Tom Lydon, editor of ETF Trends, here in Hollywood, Florida at the Inside ETF conference. I'm here with Ed Lopez, who's head of ETF product management in VanEck. Great seeing you, Ed.
Yeah, you too, Tom.
You folks have been busy, not only a lot of great products that you've built over the years, but a lot of new and exciting products. So the average advisor, as they're looking out in 2017, what are some of the things they need to be thinking about?
You know, right now for 2017, we're really thinking about a change in investment dynamics, rising interest rates, change in policies with the new administration.
Right.
We're talking to advisors about a rotation to equities. You know, when you think about some of the policies, pro-growth policies that might be coming at us, whether it's lower corporate taxes, deregulation, and infrastructure spending.
Yep.
It could be good for equities.
So we've got a long bull market, but really things are lining up that this thing could continue for a while, right?
It could, though longer term I think that case for equities is there. Short term I think maybe valuations might be a little stretched. So you got to pick your spots. Things can still be volatile, and I think a lot of the media are talking about this is the time for active management, and I can understand that, but what it really comes down to is identifying quality companies and buying them at the right price. So good companies at a good price.
Okay. And with that, you've got one of my favorite ETFs, Moat, so M-O-A-T. Just spend a minute on that and what that's all about, because it's not just active management, but it's really smart management.
Right. Well, that's a great way to put it. It's technically an index-based ETF, and some might call it smart beta, but it's really just smart investing. And it does essentially what I just said. It finds good companies and buys them at good prices. Essentially, using a methodology from Morningstar, it will identify companies that have wide moats or strong competitive advantages. Competitive advantages they can defend for 20 years or longer. And after they identify these wide moat companies, we'll then rank them by their price to fair value and essentially pick the cheapest ones. So you're buying really great companies at good prices.
So great competitive advantages for the right price, and we've actually seen some pretty companies that you and I would know a lot about that have gone up and down through this moat process, and it might be a company, I remember at one point Facebook was not in there at the opening, but once it declined after its IPO, it got snapped up because the value was there.
Right, exactly. So there are those opportunities or those times where that has happened, and we always cheer when that happens. There is some turnover in the portfolio, so the constituency changes from quarter to quarter a little bit. But again, you know, this is an ETF, and one of the great benefits of the ETF structure is the tax efficiency.
Yeah. So being able to take advantage of it. Okay, quickly, one more.
Sure.
Fallen Angel.
Yeah.
It's a great income opportunity, so explain what that's about.
It's somewhat similar to Moat in the sense of its quality and valuation.
Yeah.
It's a high yield bond ETF. Basically, it takes bonds that were originally issued as investment grade, but were since downgraded for a variety of reasons. And what happens is it captures this value premium from forced selling.
Right.
And
so institutions that have to have a certain rating status are forced to sell even though they may like the bond, right?
Exactly, right. And that's basically turned into great performance last year, and longer term, since the life of the index, it's really outperformed the other high yield indices out there.
Yeah, always great stuff, Ed. Great seeing you, thank you.
Thank you very much, Tom.